Okay, let's get started. So you know you're in the correct room. This is a session on oil, although in a conversation sometime back, the three of us decided that we're going to include gas on the curriculum here. So it will be. It's tough to have a discussion about these kinds of issues without talking about oil and gas. So we will be doing that. My name is Tom Stephenson. I'm a member of the SIEPR Advisory Board, co-founder with George Schultz of an energy task force here at the Hoover Institution. And it's my pleasure to make a brief introduction of our two presenters today, and then I will turn it over to them. They will each talk for 15 or 20 minutes, and then we'll have a discussion. I'll probably have some questions for them and hope that the audience will I'm sure this audience will have a number of questions as well. Let me first introduce Doug Luton here, who is a graduate of University of Western Ontario. We've got two guys with very different backgrounds to talk about this industry. Doug's done a lot of work over the years in modeling and on inflation targeting. He was with the Bank of Canada for a number of years, and then for, I guess, something like 13 years has been with the the IMF, the International Monetary Fund, has done a lot of work developing modern macro models to support the fund's surveillance activities. So key component of what the IMF does, and Doug has been right in the middle of it. Frank Wolak, I suspect a number of you know, Frank is here at Stanford, both at the business school and in the economics department. Frank is the Holbrook working professor of commodity price studies. That's a mouthful, Frank. Who came up with that title? And he's the director of the program on energy and sustainable development. And that's, Frank and I have seen a lot of each other in recent years as our various activities intersect with regard to energy issues here at Stanford. So with that, let me turn it over to Doug. No, I guess Frank will start, and then Doug will follow on after him. So thank you.
Thanks very much, Tom. Okay, hopefully everyone has a handout. If you don't, share with your friend. I have a few here if you'd like. So I guess, Deborah, you can hand them out if you'd like. But okay. So what I'd like to do is just give you a little bit of background of sort of how we got here in terms of the current situation in the oil market that I think is going to help, hopefully, in the question and answer period, because I think just having some idea of how oil markets work, fossil fuel markets in general work, is very helpful. So the first thing I want to try to convince you of is the fact that energy, believe it or not, is a high-tech industry. And why do I say that? That's because of the fact that really it's a derived demand for a service from a piece of capital equipment. And so you don't directly consume energy like you would consume hamburgers. What you need is a piece of capital equipment and an energy source to provide the service that you want. And so what happens is that we have technological change that essentially impacts both of those things. In particular, the technological change improves, if you like, the efficiency with which I get the energy service out of the raw energy, as well as technological change essentially allows me to get more of the raw energy out of a given resource. And what this really means is that this concept that I like to think about is called BTU arbitrage. That in other words, what I'm doing as an entrepreneur is I'm always looking for these BTU arbitrage opportunities. In particular, I'm saying that, gee, is there a cheaper source of BTUs that can provide that energy service when combined with the piece of capital equipment than the existing energy, raw energy, and capital equipment? And if so, then what I'm going to do is invest in that piece of capital equipment to be able to essentially consume that cheaper source. So, you know, and so what this typically means is if you value each of the major energy sources based on their dollar per BTU content, so British thermal unit heat content, what you'll typically see is pretty consistent with that logic in the sense that Oil is going to typically have the highest dollar per BTU price. Why? Because pretty soon, anything that oil can do almost anything. It can provide, transportation, air, water, electricity. It can provide industrial heat, et cetera. Natural gas is sort of the next highest because it can do not as much as oil, but it can do almost as much. In particular, it's not as good in the transportation sector. I'm not sure we'd want to fly in a natural gas-fired airplane, but maybe someday we will. And then coal, you could imagine a coal-fired car. No, not a chance. You'd probably be towing behind a lot of stuff. So essentially, you're going to get that BTU sort of ordering. But what's going to happen is that when there is a blowout in prices between these two things, you're going to get investments going into the one that is cheaper to be able to try to provide the service that is now formerly provided by the one that's very expensive. And so on the second page of the handout, I have this picture of BTU arbitrage in the electricity sector. And so if you look, and I apologize for those with older eyes, since I also have older eyes, but think of it as the only thing you really want to see is the big hump in the middle of the picture on BTU arbitrage in the electricity sector on the right-hand little graph right there. And you can see that right around 1979, 1980, you could see there was just precipitous drop in the use of oil in the electricity sector, whereas you can see that in the other sectors, transportation sector, we continued to use oil, and pretty much that was all that's now currently used is the really only big use of oil is in the transportation sector. And if you look down on the graph below, you can see on the dollar per BTU prices of fossil fuels, you can see that green line is much, much higher, and when that green line peaks is pretty much at the same time that the blue line peaks in terms of a little bit behind when the blue line peaks in terms of use of oil in the electricity sector. So that's just one example of this BTU arbitrage, because what happened? We said, okay, let's substitute to coal for cheaper source of BTU, substitute for gas for cheaper sources of BTU, and stationary sources to produce electricity. The other concept that I think is very important is the concept of what are reserves, and essentially the whole idea of essentially, are we running out of fossil fuels? And I have some of my choice quotes. My favorite one is the one of the Standard Oil executive who said that he would drink all the oil that was found west of the Mississippi, remembering that Texas is west of the Mississippi and so is California. So, it is an important consideration that the way I like to say it for folks in Silicon Valley is never underestimate the sort of inventiveness and ability to innovate of entrepreneurs, and that really is at the heart of what really reserves are. And on the next page, I talk about the fact that reserves are, you might be surprised to hear, an economic commodity, because I'm an economist. But of course, the point being is that the total amount of mineral in the earth is largely irrelevant. I stop pulling it out when it costs me more to pull it out than I make from selling it. And the simple thing that always gets people quite surprised is what fraction of the oil gets left in the ground after primary recovery of oil. It's roughly 75%. And so what we're doing now is at sort of trying through other sources of secondary, tertiary recovery, getting more, but at current technologies, at best, you're probably getting 60, 65% of the oil is still left in the ground after you give up. So, there's still lots of room for technological change to raise, or rather reduce that percentage that gets left in the ground, raise the amount that we get out. And in fact, that's really what's the issue is technological change is always sort of fighting against this depletion, in the sense that the two things that determine reserves are essentially the two things that we don't know too much of. In particular, reserves depend upon existing technology and current prices. And essentially, we don't know what future price is going to be, and more importantly, we just don't know what future technology is going to be. And one example that I like to point out, since it's a shameless plug to a Stanford grad, is Brightberg Energy is one such company. So this picture that you can see right here with all the colors on it, the one that's to the left of the red line, that's essentially the rate of decline of the resource that before Brightburn purchases it. And what Brightburn was founded by two Stanford geology grads. What they do is they essentially use a lot of the technology that's developed to see what's down there, as well as a lot of the newer technologies that have been developed to get more of the oil out. And then what's essentially to the right of that sort of gray area and red line is the new blue area, which is the additional output that Brightburn manages to get as a result of deploying this new technology. And then the other thing that they're able to do is they're able to reduce the cost of getting it out, since the majors are probably not as cost conscious as they might be, being more of a small boutique firm. So essentially they make their money off the fact of the blue area and the red area, because basically the green area is what the, if you like, the major that sold them this resource thought they could get out of it, and these guys realized the additional value from essentially those two areas. So it's all about technology. So the last bit is, why did I tell you all this? Well, that's the graph at the bottom here, and what you can see is this large differential on a dollar per million BTU basis in recent years between the essentially the price of natural gas at Henry Hub and the price of essentially West Texas Intermediate crude at Cushing. And you can see the one that's heading up, at least until recently, that's the price of crude in dollar per million BTU. And the thing at the bottom is the price of natural gas. What happened? Well, if you haven't been buried somewhere, you know what happened, which is, natural gas, we had shale gas revolution. And you can see on the next page just how rapid that has taken place. You can see that the green area has just exploded, and if you go to the next thing on the side, you can see just the enormous increase in shale gas production, and showing you the enormous increase in withdrawals of natural gas as a result of this shale gas revolution. This is a new, bit of technological change. So you could think of it as one of the things that happened early in if you look back in terms of the prices of natural gas, you can see that early on in the early 2000s, there was some pretty high natural gas prices. I'm an entrepreneur. I sit there and I go, well, I heard about this hydraulic fracturing and this horizontal drilling, maybe, and I know there's a shale down there that probably has some natural gas in it. What the heck, if I can get it out, I can make a whole lot more money. Why not give it a try? We have a lot of failures. We finally figure it out, and sure enough, we start to get pretty good at it, and we start to produce a whole lot more natural gas, and everybody else sees what I'm doing, and they do the same thing. And the other thing is also happening with respect to crude oil. The same is occurring. So, for example, California, we are now no longer number 2 oil producer in the United States. As I'm sure everyone knows, it's North Dakota is the number 2 oil producer in the United States, and that's pretty much all because of shale oil. And you can see on the next page, where I've got the price of natural gas as well as the monthly oil production, you can see that we're almost at historical high levels of production in the United States. You can see that in millions of barrels today, we're pushing up against 10 million barrels a day, which we have not seen since the 1970s. And then the last bit that I'll just leave you with is the obvious. What's happened is the price has cratered. Largely, and the interesting thing is, the other thing that's interesting and has some relevance to a lot of geopolitical kinds of things as well, but geopolitical in the United States, is the difference between the blue line, which is WTI, that's the price at Cushing in Oklahoma, and Brent, which is the price of crude in the North Sea. You can see that very persistent differential, meaning the WTI is selling at a significant discount relative to Brent during this period when we've had this explosion in shale gas. And that's an interesting implication of what's going on. But in the interest of letting the other speakers speak, I'll stop there. But with that background, at least hopefully give you enough to tee up questions. So take it away.
Thanks.
Doug?
Okay, can everyone hear me okay? Okay, so thank you very much for inviting me to talk. This is joint work with Oreski, who's the head of our commodities unit in the research department of the fund, and Armen Nerbekian and Ho Wang, which did some of the modeling work that I'm going to be talking about. The title of this is The Future of Oil, Some Illustrative Simulations, and I want to really emphasize the word illustrative, okay? So I'm going to be talking about a framework that allows us to think about the problem and to produce these illustrative scenarios and measures of uncertainty, which is probably the most important thing that we want you to think about. So if you turn to the next slide, slide 2, there are really 2 extreme views of the oil market. One is the geological view. By the way, the second page. So this is actually in an IMF.
Summary page.
So this is in an IMF working paper called The Future of Oil, Geology versus Technology. There's going to be another version of the working paper coming out that basically has what I'm going to be speaking about today, plus a lot more details. But anyway, in the working paper, we documented these two views of oil. One, of course, is the geological view, which is the idea that physical supply constraints will dominate the future evolution of oil output and prices. This is called the peak oil view. This view was obviously systematically too pessimistic between 2003 and, for example, the period before the global financial crisis. But there was also another view, and there was actually a very common practice inside institutions to project future trends in oil demand and assume that supply would adjust to accommodate the increases in demand without higher prices. So our story is going to try to nest these two views. It's going to be a story where oil can become harder and harder to get out of the ground. And as a result of that, we can go into these episodes where prices can trend up. And then, of course, then there can be bursts of technology, to pick up on Frank's point, where oil prices can then be low for a period of time. But anyway, I'm not going to show you any equations. If you want to look at the IMF working paper, it's a nonlinear model, and there's uncertainty that's modeled formally, where we can look at things like risk scenarios and tell stories that are based on the fundamental laws of demand and supply. So that's basically it. It's a consistent framework that incorporates demand and supply. The issues that we're focusing on are more medium-term types of issues. So this is not a framework for forecasting short-term oil prices, okay? This is more about thinking about the medium-term determinants of oil prices. One of our messages is that there's going to be massive uncertainty in future oil prices and production, and obviously that implies, given the lead times for investment projects, to consider the implications of that uncertainty for future prices of oil and their implications for policy. So we can just turn to the next slide, slide 3. So it's a graph of oil prices. And anyway, you can see that they were roughly stable up till about 2003, and then they started to basically go on this upward trend. Our interpretation with the model was that that was a period where growth picked up, China, other emerging Asia countries, and there was a series of disappointing supply developments. Okay, so our model interprets it as, you know, with a nonlinear function where it's harder and harder during certain episodes to get at the oil or to produce it with existing technology. Then, of course, during the global financial crisis in 2008, you can see oil prices fell from about $150 in July, and then as the economy recovered, oil prices then stabilized around $100, and more recently, they've collapsed over the last year. So you can see that OPEC spare capacity on the chart below is very, very well timed. So when the market was really, really tight, there was very little OPEC spare capacity, oil prices started this upward trend. So we have a model that can actually explain this phenomena of upward trends in oil prices from time to time. And then, of course, supply comes into action, shale oil in this particular case, which can then result in a downward revision in oil prices. The key thing, I guess, is uncertainty. That is described on page 4. So we have, for example, the current projection of oil prices, as well as confidence bands. And these confidence bands are constructed, you know, from model-consistent estimates, looking at uncertainty in the supply fundamentals and uncertainty in the demand-side fundamentals. It's a very simple model, a model that's based on endogenous output, endogenous demand, endogenous supply. Of course, the price is determined by supply and demand, okay? Now, that's the top-down approach. As I take you through that story, I'm also going to show you the bottom-up approach, where we ask, where would the oil be coming from? So there we look at all the details in terms of, you know, where are the potential changes in production that we project with the model. Where would it actually come from when we think of it in terms of conventional oil or shale oil or deep sea or oil sands? So the first thing to note is that the confidence intervals are very, very wide, okay? And there's two reasons for that. In the very short run, because the model has very, very short, very small short-run elasticities of demand and supply, that means that it can require very large changes in the price of oil to equilibrate demand and supply. So, for example, one implication is that the price of oil can collapse if basically there's positive news on supply and negative news on demand, and that's basically what's happened over the over the last year. More importantly, when we think of the medium term, there's incredible uncertainty, again, through technology, uncertainty about technology, which is the point that Frank was making. There's lots of uncertainty in the cumulative sum of basically these surprises in demand and supply, and as a result, the confidence bands get wider and wider over time, and as you can see, our baseline forecast in 2025 is about $100, but the 90% confidence intervals are very, very, very wide, so somewhere between $35 and $180, okay? This is very, very important when we think about, it's not a question of developing one scenario, which has a zero probability of being achieved. We need to think about models to incorporate uncertainty. If you turn to the next slide, you'll see that illustrative baseline scenario. Again, I emphasize, with zero probability this event will actually happen. But I want to show you how we can then take that zero probability event and then map it into a more detailed bottom-up story. So what's the story? Moderate growth of 3.6% for the global economy. That's going to require, again, given these assumptions about the supply of oil, that prices are going to have to rise over time to about $100 by 2025, and this will be sufficient to generate an additional 10 million barrels increase from current production levels. Okay? So if we turn to the next slide, we can then see how that squares with a scenario based on, that's bottom up, that asks where would those extra 10 million barrels come from? And would it be consistent with assumptions about the cost structure of producing the marginal barrel of oil, in other words, the most expensive barrel of oil? So we have 4 different types of oil in the pictures. One is conventional oil, that's the cheaper oil. Now, I just want to caution you, that's cheap oil, but it's also oil that's declining. Existing fields are declining somewhere between 4 to 6% a year. So roughly 25 million barrels. A massive amount of investment has to take place simply to tread oil.
Where is most of this conventional oil come from?
Where does it come from in the future?
No, now.
Now? Well, a good chunk of it comes from, it's mainly the Middle East, okay? But if you think of those decline rates, so say it's like, just to give you an idea of perspective, so say it's, if conventional oil is about 70 million barrels. So if the decline rate is like 5%, 5% is 70 million is 3.5 million barrels. So this is, Saudi Arabia output is like 12 million. So this is sort of like finding a Saudi Arabia every 3 years. So I just want to emphasize that there's some uncertainty.
Very unhappy if we found a Saudi Arabia.
So I just want to emphasize that there's uncertainty in actually projections of the supply of conventional oil. In the scenario I'm going to show you, it's going to assume that conventional oil basically is unchanged, okay, that basically it's plateaued, and that additional 10 million barrels will have to come from shale oil as well as more expansive deep water and oil sands oil, okay? So in the scenario, you can see that an additional 5 million barrels comes from shale oil. So that's the cheaper type of oil relative to ultra-deep water or oil sands. Production capacity can be expanded fairly easily. Oil sands is something in this scenario that would have to basically double. So it would have to go from 2 million barrels to about 4 million barrels. And same thing with ultra-deep water. Incredible uncertainty in these estimates, okay? I want to really emphasize that. So obviously, since there's uncertainty, what we need to do is study some of the implications of that uncertainty. Now we can turn to slide 7. So this is looking at uncertainty on the demand side. So what we're doing here is looking at an upper and lower bound estimate of world growth. So as I said, in our baseline, we have 3.6%. So we consider an upward scenario where world growth would be 4%. So this would require an additional 1 million barrels per day by 2025, and an additional 10% increase in prices to be able to generate the incentives to produce that additional 1 million barrels of oil. As you can see, the downside scenario, the lower growth scenario of 3.2, is roughly symmetric. So the upside, the downside, those kind of risks on the demand side are roughly symmetric and not too large. Where most of the uncertainty is on the supply side. And to go back to Frank's point about uncertainty about technology for getting at the oil. This is presented on page 8 that shows an upside scenario for oil production, where oil production would be 1 million barrels higher than what's in the baseline. So this would be consistent, for example, having more, we have positive surprises in terms of producing shale oil. So one could think of it in those terms. One could think of it as more conventional oil. You could think of it a number of ways. The other scenario, the red scenario, is a scenario where we could actually have disappointing news on supply, much like what we saw during that period from 2003 to 2008, where there was a sequence of negative surprises on the supply side. So in that scenario, you could have oil peaking at about 99 million barrels and then starting to decline. That would require, of course, a much larger change in the price of oil and would take oil prices back up to levels that we saw just before the financial crisis. So up into the 130, 140 range. Remember, they peaked at 150. So conclusions, last slide, I already took you through some of these. Hopefully I've tried to convince you that we need to have a framework that integrates demand and supply, studies uncertainty seriously, so that we can think about what the implications of that uncertainty is for oil prices and thinking through policy issues. So on that note, maybe we can...
Okay, thanks, Doug. Let me ask a couple of questions first and then invite participation by everyone. Really complicated to figure out what's going to happen coming out of this current dramatic drop and its impact on supply, particularly from a lot of the smaller companies. A lot of what's driven the tremendous increase in oil production here has been a lot of entrepreneurial companies. They're under enormous pressure now with the prices having dropped as precipitously as they have, and you have to wonder a little bit about how quickly they'll be able to recover. That's kind of on the negative side. On the more positive side, I mean, there's a lot going on in Canada. One of the ways that we frequently think about energy is from a national security standpoint. And when you look at what's going on in North America today, with what's going on in Canada, prospectively what can go on in Mexico now that their Pemex is going to be opened up and there's going to be opportunities for a lot of the deep water opportunities down there. How should we think any differently about how fast production, North American production, can come back here? Because that has a big impact on how we think about OPEC and the Strait of Hormuz and kind of what the rest of the world is implying.
Production is only heading up. I mean, so it's more about exploration and drilling. And I think the one thing that has changed a lot in this industry is that you could think of historically the way that oil worked is that you went out and you tried to find a conventional deposit, and what would happen is those typically be such a large deposit that it would pretty much, in order for the market to swallow that large deposit and that high rate of production that accompanied it, price would fall. But, and then price would come back up because of the fact that the demand was pretty, inelastic for oil over time as the sort of demand grew over time. But the difference is now is that it really is sort of almost like a constant marginal cost production process for oil, because with essentially shale oil, what you have to do is that you essentially get probably, 70 to 80% of the oil that you're going to get from that well in the first 2 years. And then what you'll have to do is you'll have to re-drill, refrac, and keep going, moving along with the shale. And so as the price of oil moves up or moves down, you could think of it as you now have a much flatter supply curve hitting a vertical demand curve, and so therefore you're going to tamp down the price volatility that you're going to see in oil, because what will happen is just people will go drill. I mean, just to give an example, there was over 37,000 oil wells drilled last year, and roughly over the past 5 years about 30,000 a year. So you do have to keep this rate of production up, have to drill, but you can easily throttle it up and easily throttle it back as the price moves.
More of a geopolitical question, but looking at the world supply today, historically we've always had local markets on natural gas and world markets on oil. Is that likely to change at all, given some of the dynamics we've been talking about? I mean, right now you're seeing OPEC having separate prices for what they're selling into the Far East versus what they're selling here. Are we seeing, is there a prospective likelihood that we'll see more local pricing of oil? I mean, some of the difference between Brent and WTI suggests a little bit about that now. Is this something that we're more likely to see going forward? It may be that natural gas is going to be moving more towards a world market over time, and that oil could take on some more local characteristics.
Well, the Cushing discount is largely just simply because of the transportation network. I mean, think of it as the way that the natural gas and oil pipeline infrastructure was built in the United States was largely to take stuff produced in the Gulf Coast region up to where everybody lives and across west to where everybody lives. But now what you've effectively done is, think of it in North Dakota, you now have this large amount of oil coming out, and there's no pipeline that is going to be, or the pipeline can't take it all essentially down to market to get it out. And so as a consequence, the price at Cushing is significantly lower than essentially Brent, because you just can't get the oil out. And the way that you do get the oil out is you literally put it on trucks, you'll put it on trains, you'll do all sorts of other stuff that's extremely expensive because you don't have the evil word, a pipeline. So that's the issue. So the reason that you get these differentials in prices in terms of oil is simply because the infrastructure cannot allow the oil to move. So because the oil is pretty much oil. And as you can see, if you look in the graph, historically Brent and WTI traded spot on. And it's largely because all you would do is just point the tanker in the direction of the highest price when it's in the water. So, but the other issue that you mentioned I think is extremely interesting, and that's the issue of, can we have an integrated global market for natural gas? And here I think the important point to bear in mind is different from oil, which you can just, you take it out, you put it in a barrel, and you can put the barrel and move it anywhere. With natural gas, it's got to be in the pipeline. And so in order for me to move that oil from effectively region to region, if I don't have a pipeline, I typically have to liquefy it.
Right.
In order to liquefy it,
tanker.
I take a BTU hit. I've got to pay for the cost of the LNG liquefaction facility. I have to pay for the regasification facility. That adds, at least at current sort of numbers, that adds about double the price of the current U.S. price to it. So the interesting thing is that you'll have these countries that if you have your own shale gas, you'll sort of be the have. You have a natural gas that is trading at a significant discount relative to the countries that have no gas, who are going to have to essentially pay for that transportation cost. And just to give you, again, some illustration of that, if you go to page 7 on my handout, what you have is essentially graphic illustration of that. Is that it's the figure that says estimated landed LNG prices for August 2014. And what you can see is that we got deliveries in the Gulf Coast region, coming in at $4 per million BTU. But, you know, you're in Korea, you're in Japan, you're paying, you know, $11 per million BTU. It's identical, you know, natural gas, methane. The reason is that currently, why aren't guys that are producing gas and selling it for $3 in Lake Charles, Louisiana, selling it to Asia? It's because there is currently no LNG export facility operating in the continental United States. So essentially, you can't exploit that, but there are a number of contracts being signed right now to essentially get these facilities built, most of them on the Gulf Coast, to move that LNG to the places where the prices are significantly higher.
That does beg the question of the impact of the current export controls and whether taking them off, which I think is something that's likely to happen, what impact that'll have on pricing and the ability to move the gas.
Yeah, no, I do question the logic of you can't export American oil, but yeah. But that's less of an issue if you're a net.
But isn't that a big reason why Brent and Cushing are different?
No, it's fundamentally just the fact that you can't get the oil. There's no easy, low-cost way to transport the oil from where it's all coming out in the Midwest. We all think of it as we all of a sudden you're sort of like trying to get this oil in this little skinny pipe, and so people are moving.
Cushing is in Oklahoma. You're just transferring it from Oklahoma to a tank.
No, you can't get it from North Dakota down. That's the problem. And now the only way that you can get
It must be
it.
in Oklahoma for it to be the Cushing price.
Excuse me?
Isn't it in Oklahoma to be the Cushing price?
Yes,
So you're talking about transferring it from Oklahoma to the Gulf Coast.
Yes, and that's
You have
expensive.
that. You have that capacity, it's just going the wrong way.
Some of them are at the moment. Yeah, there are, you might be.
Isn't the export ban?
No. It's like I said, it's an infrastructure constraint that you can't get the oil out to essentially arbitrage that price difference, and typically you can. And it's largely because there's a lot of oil being produced in the Midwest in a region that did not historically produce it.
Oil is priced in dollars, obviously, but the dollar has been going up in value, particularly with respect to the euro, from $1.50 right last not so long ago to the dollar now.
Can you repeat the question for us?
Wait a minute, Pitch, can we hold off, because I want to go back to, we'll come back to, I want to come back to Doug for some observations on my initial question here.
Sorry, yeah, because we have a perspective on this. So today, as Frank was saying, the elasticity of supply because of shale oil is higher. So in other words, if you just go back to my picture, I don't know, I assume some of you aren't oil experts, so we try to break this down in very intuitive terms, but it has a picture of basically what a shale oil well looks like. This is about $1.5 million kind of dollar operation. If you look at oil sands, so this shale oil, you can ramp production up and down fairly easily, okay, relative to things like oil sands in Canada. Like, you know, once we get there, you know, we need massive lead time to develop not only the oil sands that require big investments, but as Frank was saying, you've got to get it to market. And there's big environmental concerns about, you know, getting oil sands to market and so on, right? So I just want to emphasize that we're in an environment for the next few years where this marginal barrel of oil is probably going to be supplied by something that's much more elastic than other types of oil where it takes massive investment.
But was the absence of the Keystone Pipeline a limiting factor on the oil sands production?
So certainly, and
What's wrong, why is there such an objection to the Keystone Pipeline?
That's a wonderful question,
It appears
to
to
which
be a
there's been
religious
no
view.
good answer forthcoming.
But,
I mean, what happens today is that oil is moving south either in rail cars or on surface highways, which is a much less safe modality.
People don't want it, so why don't they want it?
It's those who are opposed to anything related to fossil fuels. At the end of the day, I think that to fossil fuels.
Oh,
This is a green, very much a green, yes.
CO2 problem, not an oil thing.
Exactly.
Well, it's hard to see how you could almost argue the opposite, that it creates more CO2, simply because you're going to be trucking it, training it, rather than putting it in a pipeline.
But look at these.
They don't see it that way.
Yeah, but, yeah.
Look at these rail car. I mean, I frankly had hoped that some of these rail car accidents would create some stimulus for building a pipeline, a whole lot safer modality in which to move it. Pitch, go back to.
I just wanted to get to this, it's related to that last issue. Oil prices come down by our charts and we live in dollars. We don't live in euros, we don't live in other things, so for those people, the oil price has not come down anywhere near as much because they're paying more for a dollar. I just wonder, as you figure the future oil prices.
I'll repeat it.
Oh, I'd be short then. As you figure on future oil prices, what role does the value of the dollar compared to other people go into your calculation?
So the question is, the dollar is appreciated, and so countries that have experienced basically movement in their exchange rate, that's worked to offset the effects of the decline in the price of oil, and that's absolutely true. So lots of countries where the exchange rate has moved, their prices are not falling as much as.
As much as the dollar's gone up from about 3 years ago, it's gone from $1.50 to $1. That's a third change.
Yeah. So
when you're figuring, does it come into your calculation?
yes, of course. Yeah, all those things come in. I mean, in terms of the model that I'm presenting today, we have models of various complexity. This model is a simple model just to illustrate the ideas, but in terms of our analysis at the fund, we look at everything.
Just wanted to get your view on changes in global demand elasticity. So with CAFE fuel standards sort of in the U.S. and declining oil intensity per GDP, are there estimates for how that'll evolve in some of the more emerging markets that have been very energy fossil fuel intensive, but maybe are reaching an inflection point? How does that sort of look on the outlook?
Yeah, I mean, I think that there certainly is evidence that the elasticities are larger. I mean, I've actually done stuff looking at gasoline, and there's many more margins that people seem to be able to substitute on in terms of reducing gasoline consumption. You could think of hybrids, electric vehicles, 2 cars, all sorts of different ways that perhaps didn't exist. There's also been a tremendous amount of activity pushing people. I mean, to make a shameless plug for policy brief, SIEPR policy brief. How about that, Deborah? It's on the end of expensive oil. So one of the things I discuss in there is the fact that if you look at sort of the transportation sector, there's quite a large BTU arbitrage. You go, okay, $50 oil, take the standard conversion factor, that's translating into roughly about $8 per million BTU. Current price of gas is $3. I convert my car, I drive a UPS vehicle that burns natural gas as opposed to oil. That looks pretty darn good. Now, the only problem is the infrastructure, but if what my vehicle does is drive in a circle and come back every day, that looks like a great investment to me. And and that is happening. And the other is it's much cleaner. You get a much cleaner burn. You get fewer particulates. So it's a great idea if you're going to have fossil fuels powered vehicles in a city as well. So so it's one of those. Another thing you could see is that the slides, which are the source of all that's good in this talk, is essentially if you look on page 6. You can see that what we've seen is you've got a graph of essentially greenhouse gas emissions in the United States, and I drew the little vertical line for you to show you that even though GDP continues to grow, you can see that greenhouse gas emissions fall. That's all essentially substitution from coal to natural gas into natural gas in general. Natural gas produces roughly a half to a third of the greenhouse gases per megawatt hour of electricity. And so it works on both dimensions, both the environmental dimension as well as on the the economic dimension. But it's the economics that are driving it.
Big impact in emissions, or issue that you have to take into account as you look at emissions from the transition to electric vehicles is what's the source of the electric power that's powering those generation statements. And it makes, I mean, you don't accomplish a whole lot if you're using coal-fired power plants to drive your the electrification process. Natural gas is fascinating when you, and Frank was alluding to this, when you get into particularly the fleet operations where the infrastructure is much less of an obstacle. Do you have any statistics on how widespread the natural gas?
It's moving so fast, it's hard to get good numbers. Yeah. That's the big problem.
What
But there.
about countries like Russia and China? What kind of access do they? Russia, of course, has.
Well, China, again, go to the handout right here. Another one I put in there for you. If you go to the handout, in the last page, you can see that China, at least our USEIA estimates, China has the world's largest shale gas reserves. Now, the big question mark is, can they exploit them? And I think here the interesting question is something that Tom alluded to, which is, in the U.S., it's not a nuisance for somebody to drill on my land if I get the benefits of what they find. But in China, the mineral rights are organized differently. The other is water issues in the case of the United States, and China has significant water issues as well. But, so that's the real question mark. The other is also the geology. The geology of actually exploring for those is quite different. But the other thing that's also true is that virtually all the major plays in the United States, shale gas plays, have Chinese partners that are attempting to essentially learn their lessons from the U.S., as well as they're trying to get the many U.S. firms over there working to try to get shale gas developed in China, which could have some enormous environmental consequences given that China basically consumes lots of coal.
I was out in Beijing a couple of months ago with a group primarily from Hoover and some other parts of Stanford, some other folks from around the country, to talk with the Chinese about what's going on in the South and East China Seas. And my role in it was to talk about it from a natural resource perspective. And I mean, there are substantial prospective, I mean, there are significant resources of both oil and gas in deep water environments in the South and East China Seas. And one of the things that China desperately needs is the technology capability to do a lot of that. I think there are prospectively ways in which we can be helpful to them. They don't want our help because as you follow what's going on in the East and South China Seas, they're busy trying to make sure that that everything that's there in terms of natural resources they want to take title to. And they're using some really extravagant rationales to get there. But China's, not only do they have a lot of prospective deep water resources, but they've got shale gas onshore as well. They just have lacked some of it, the technology, and some of the whole infrastructure issue, the governance, who has title, who has ownership to what. So it's a complicated process, but when you look around the world today at what's going on with both oil and gas, I mean, the changes in the last 10 years is just remarkable in terms of what's out there. Douglas?
Yeah, just to go back to your question about the elasticity of demand, that's a great question. We have to think of oil, it really powers the transportation fleet at this point. Obviously, there are substitution possibilities, electric, natural gas. When we're thinking about scenarios where the price of oil could be rising over time, obviously if it's inelastic, an increase in the price of oil means that it will take a bigger share of the household budget. So at some point there will be incentives for people, when the budget share that's used for oil gets bigger and bigger and bigger, there will be incentives or trigger points where basically households will move to other things, and that will depend on how much, whether or not you've got the infrastructure in place to use natural gas and so on. But it'll also depend on things like how rich the country is. So, like for example, Germany has the infrastructure, but they're not switching to natural gas. If you look at the technology for cars, virtually every car company has a natural gas car. But nobody's demanding them at this point because basically the price of gasoline isn't high enough to make people switch. Now in poorer countries like Armenia, for example, one of my colleagues is from Armenia, they've switched to natural gas simply because you know, they're prepared to pay that convenience cost of using natural gas because they're afraid of what the what implications it would have for their expenditure share. So the point is that econometric evidence, like on the basis of one country, is going to have limited value. You have to look at sort of how the world reacts, what their income levels are. It's a very, very complicated question, but.
Yes, go ahead.
A major portion of the conventional oil comes from countries where that oil supports the infrastructure of the country. To what extent, as the price fluctuates, do you bump into a situation where the country gets in real trouble, Saudi Arabia included, where they have to have a certain price or the country will float? It seems to me that until conventional oil becomes a much smaller portion, at some point, that's going to put a major floor on the cost of oil.
Well, but you're seeing that today in Iraq. You've seen it in Libya. I mean, you're.
They both have increased their production a million barrels in total. So.
Extend that to its logical extreme and say that at some point you could have a war over it because it starts to bury them.
But the good news there is that all these guys are, like you said, are in deep trouble fiscally because they didn't plan on, $40 a barrel oil, so they have huge fiscal deficits that they're running, and that means that, number one, they're not thinking about withholding output because they need all the revenues they can get, and so that's sort of more good news for oil staying in the ranges that we're seeing right now, is because only by maintaining quantity can I keep the revenues coming in, because essentially the share of global production coming from the OPEC countries is declining and been persistently declining over time. So their sort of ability to move prices globally is significantly limited.
Well, the geopolitical consequences are fascinating. I mean, look what's happened in Venezuela. I mean, you mentioned earlier, Kathy, you offered up Russia and China at the same time. Well, the huge difference. Russia's a major exporter, economy heavily dependent on oil today. Oil?
Yeah, what kind of oil is it?
Oil and gas. I mean, it's both. It's both. It's oil and gas, and it's the mainstay of their economy. And if anything might bring Mr. Putin down, it could well be oil and gas. Yes.
Tom, I have a question. It's from the first plot that you have in your presentation, and it's the recent history in a nutshell. And so you give an explanation there in the box of that first chart of why oil prices went up so much.
Right.
But then they dropped precipitously within 6 months. They had jumped back up to $75 a barrel, and within, 12 to 18 months, they were back up to 100. Can you explain to me why that happened and why you were instead projecting that it's going to take 5 to 10 years to get to those levels again?
Sorry, where do you see that we're projecting? Sorry, the red line.
2009, the last time we had an incident like this.
Sorry, the red line is basically just from the futures market. It's not. It has nothing.
You had some projections later on, which you showed with big bands.
Yeah, but that's today. So that's the projection based on today's information. Okay, so we.
Went back up again.
So in what period?
Less than 18 months.
In what period exactly?
2011. From 2009 to 2011.
I mean, there's very little. I mean, there's not a lot of variation, but the idea would be that because the elasticity of demand.
I don't know what happened the last time and why it's not going to happen again.
Oh, okay.
And people like the OPEC people are driving the price of oil, not demand supply.
Okay. Yes. So
what happened here? That's what I wanted to.
So I want to be really clear. The story that I was telling basically is more of a story about the medium term. So the model that we've designed here is more about medium term, longer term fundamentals. Okay. So to study things like the short run movements, we'd have to look at all kinds of complicated issues.
So at the danger of getting your ire up, I would say that if you look at oil inventories, what you will see during the period when the price was extremely high is oil inventories were very low. And then if you look at the time right now when prices are very low, oil inventories are up extremely high because everybody's basically saying, boy, I sure hope that I don't want to have to sell it at $40 right now. I'm hoping it'll go back up. So the evidence for sort of oil speculators influencing the global price of oil, this is the global price of oil at roughly 80 million barrel per day oil, the market, is really hard to find. But you know, and largely because if you...
I'm just asking a simple question. I don't know why the price of oil doubled between 09 and 11. You gentlemen are supposed to be experts. What's the answer? I don't have any higher.
No, I meant in terms of you seem to have thought it was the speculators. I was just simply trying to counter that it.
So that one was easy. We had this thing called a global financial crisis, okay, which broke out in late 2008. So the demand for oil fell because there was there was very short run elasticities of demand and supply. So even small changes in demand, reductions in demand, will result in a fairly violent price change. Okay, now if we get into the details, Frank's exactly right. We look at even higher frequency movements. We have to think of inventories, and we have to think of the role of OPEC. We have to think of many things. But in terms of the fundamental, the global economy recovered. So demand, it occurred gradually. No, it doesn't have to, because in the short run, the price is going to overreact because of these really low short run elasticities. So in the short run, if there's a small change in demand, the price is going to react a lot to clear the market. But over time, because those elasticities are higher, as basically
I think the GDPs went up by 1%.
So let me give it a shot. So historically, the way that sort of, if you like, planning in the global oil market went was you serve the guys that consume the most, because they're going to grow the fastest, and those would be the United States, Europe. But what's been happening in the United States and Europe is, if anything, oil demand has in fact declined or remained flat. But the thing that sort of, I would argue, caught everyone by surprise in the period with the big run-up was the fact that in the developing world there was rapid growth in oil demand. So, for example, China was essentially growing it on the order of probably a little less than 1 million barrels per day per year, which is a lot of demand growth. And given essentially, what Doug's talking about, if you've got basically a very inelastic demand and it's shifting out and you've got a very steep supply, then what happens is a little shift out in demand that you didn't expect, boom, the price goes way up, and demand shifts back in, very quickly drops back down.
But he's projecting that's not going to happen again.
No, I don't think he is. I think if you look, I will defend my colleague here. He's got some big error bars there. He's saying almost anything can happen.
Well, who was forecasting it was going to go from 100 to 50? Or
I'm the one that's saying that it's unlikely. But I'm at least giving you, that's why I have a question mark after my little
okay, we got some questions in the back.
To what extent do we see economic warfare with Saudi Arabia versus Iran or Russia or Venezuela?
Sorry, I couldn't hear.
Saudi Arabia has
Yes.
a problem with Iran. To what
Yes.
extent, and we have a problem with Russia. To what extent have they driven the price down in the form of geopolitical warfare?
Hard to judge. I certainly haven't seen any data that would suggest that's going on.
I mean, think of it as we've added roughly in about the past 4 years, almost 5 million barrels per day, 6 million barrels per day more. I mean, that's a lot of supply, and so that's really, and demand is not moving that fast. So that's really, I think, a big reason the price dropped as fast as it did.
But isn't some of that supply coming offline pretty quickly now that oil's at 45?
Well, I would argue it's just simply, as what Doug said, is that if you want to maintain production, you have to keep drilling. And so guys are just going to slow down drilling. But, even the good news is that there's still all the rest of the world that hasn't really deployed the shale gas technology and shale drilling technology that we have in the U.S. And the other thing to remember is this industry in the United States is probably about, less than 10 years old. This is an infant industry. They're basically working out all the kinks in terms of standardization, is how they drill, how they deal with the fracking fluid, all these kinds of things. So, I mean, this is a really, really young industry, and it seems pretty likely to me that, it's going to spread to the rest of the world. If you think in terms of what happened with conventional oil and gas, is it started in the United States, and then we go abroad and we do wonderful things and bring the oil back to the United States. So, it's sort of, I would agree with you, but, there's lots of people willing to pay lots of money for what you bring up. And, and that usually makes people look for it and find it and bring it up.
Deep water opportunities are prospectively huge. I mean, cost issues in getting there, but.
Is the deep water a loser in that scenario?
Well, I would expect that deep water is not coming, because is that it's certainly, if you think deep water is getting drilled for the $100 a barrel bonanza,
It's not gonna.
You might think that those guys are going to, if it's sort of how long is it going to stay at the level that it is. But the thing is, they're going to continue to effectively get what they've got. But it seems like that's where I'd be sort of putting the brakes on, in the sense of why do I want to sink these billions of dollars for the prospect of getting this oil, when I know that on land guys are going to be, or shallow water, exploring for shale oil, and it's fairly simple to replicate technology. I mean, yeah, the various oil services companies. I mean, the other thing that's happened is for those of you who Baker Hughes and Halliburton have merged. Right. Part of it to provide sort of one-stop shopping to make this stuff happen, and that's certainly going to help these guys get it going and reduce costs and get to the resources.
I thought it really interesting that you guys are both sort of forecasting a decrease in the volatility of the price of oil to a certain extent, due both to the sort of ease of which you can dial up and down supply, as well as the ability to maybe substitute and technology helping out on that end. As I look at this graph over the last decade, it may be a scaling factor that I just don't have a long scale on here, but it doesn't look like we've seen any evidence of volatility decreases yet. And certainly your model doesn't suggest like volatility is going down. I don't think, otherwise your model a decade ago would have.
But I would just want to qualify to say that mine was a ceteris paribus statement, which means in the sense that this is a reason to believe volatility will be less because of this sort of drilling technology. But there's one source of volatility that you can't control for, which is what Tom was referring to, which is something bad happens in the Middle East. There's a supply interruption. Somebody attacks somebody else, and you have supply go offline. So I don't think. I mean, I would just do the two-handed economist here and say, look, if there isn't a lot of conflict in the world, but unfortunately, given the stuff that you see with respect to the large deficits that all these governments are now running, there's likely to be a few more Arab Springs, because guys are going to go, hey, you're not giving out the goodies anymore because you can't afford to give out the goodies, and so bad things could happen. So that's the other side of it in terms of potentially greater volatility. But in terms of the economics and the volatility, if you think in supply and demand, supply is getting flatter, demand is probably getting also flatter, but you still get these geopolitical events coming in that take supply temporarily off the market and will spike the price temporarily.
Okay. So frequently now, like that was,
well, let me look into my crystal ball and see. I mean,
I'm wondering, like, if all else equal, I would just expect like your comments to say like, yeah, even if those geopolitical events do happen, it should have a slightly more muted effect, and unless I believe like we're going to see an increase in those types of events, I should be able to bet on ball of oil.
Yeah, I mean, let me give it again then. So think of it as, to the extent that what we're doing is, suppose what's true is we have a transportation sector that has a larger share of CNG vehicles and LNG vehicles. Suppose that we have more electric vehicles, other kinds of things where we've sort of, consistent with what I was talking about with BTU arbitrage, where we sort of have a portfolio of raw energy sources that we can count on to effectively meet our energy services need, then yeah, I'd agree. You know, that we're going to get less volatility because effectively guys are going to go, hey, that price of oil's too high. I'm going to drive the electric car today, or I'm going to, I'm not going to do the things that are consuming the oil. And the interesting thing is if you look, is that that's why, when people, there's some nice studies that were done looking at, say, like the elasticity of demand for gasoline around the Arab oil embargo versus the elasticity of demand for gasoline right now. And around the Arab oil embargo was very inelastic, largely because it was like it just caught everybody by surprise. But we're used to living in a world with volatile oil prices, which means you make investments to essentially mitigate against that risk, and that then in turn is going to reduce the sort of price elasticity, or increase the price elasticity of demand for oil that you face, because people have these other capital energy consuming capital goods that provide equivalent services.
So,
I was just going to.
Do you want to add something to that, Doug?
I just wanted to say that I agree with that. There's lots of things that drive volatility. This is just, if the market was really tight, we get back into 2003, 2007 sort of territory, I would expect that would increase volatility, okay? But right now we're in this place, but that's only one argument. There are other arguments that would drive volatility. I just want to caution this idea that basically we can take this shale oil and export it to the rest of the world. There's sort of three reasons why it's worked so well in the U.S. One is property rights.
Right.
So basically you can go and buy the rights. People own the rights to sell. Two, there are environmental concerns in the rest of the world where population density is really high. There are even concerns in the U.S. where population density is pretty high, right? So there are environmental concerns. The last one is geology. So the actual structure of the rocks is a little bit different in the rest of the world, and the types of technology, to go back to Frank's point about technology is important. So the actual technology that we have for doing shale oil is suited very well for the U.S. That doesn't mean that we won't discover a technology for doing it other places that have different kinds of rocks, but I just want to throw a little bit of caution that this is going to be an easy process, taking the existing processes in the U.S. and basically doing it in the rest of the world.
I think there's a fourth factor that I would put in, Doug, which is the spirit and culture of entrepreneurism in this country that you don't find in many.
The good news is we have IOCs, international oil companies. They're real good at going in places that are not really safe and getting the oil out. But yeah, I certainly express all those caveats, but I think the history is pretty good on the international oil companies.
All right, Kathy, we'll try another.
Plus we have the Chinese oil companies to help us.
I would like to say that I think you're perfectly right that the United States is one of the few countries in the world where you own your own oil. The government gets the oil from other countries, Russia, et cetera. People don't own their own oil. But here, you pay taxes on the money you earn. It's from your oil, which is how the government gets their shot. But the way things work in this country is different from the rest of the world in terms of oil. Two questions back.
Yeah.
If we were to fast forward 5 years from now and oil prices were still around current levels, so call it $55, $60, what would be your best guess about why that would occur? Would it be weaker than expected demand, higher than expected supply, or maybe a change in the cost curve due to improvements in technology or slimmer profit margins for service companies?
So the question is, what if the price of oil stayed at $50 over the next 5 years? And how would we possibly account for that? So it's a hypothetical. So obviously it could be weaker demand growth. That's one possibility. The weaker demand growth could be because that world growth is lower, or because there's more efficiency gains. So in other words, the oil intensity improves more substitution, as Frank was saying, to other things. And of course, the last thing is that we could have positive surprises in shale oil and other forms of oil. And so, there could be encouraging supply developments over the next 5 years. Now, I'm kind of worried about that scenario, actually, because if prices stay low, the longer prices stay low, then the less investment we'll have, the more difficult kind of oil to. So in that scenario, I would have a cobweb kind of story. In other words, oil prices stay low for 5 years, that discourages investment in these bigger projects. And of course, then that sets up a situation where oil prices could spike possibly in the future. But
Well, if you look at the forward curve, it looks pretty flat. So that's what the market thinks. So, I mean, I guess in terms of to me, it seems that this is a pretty young technology, and it's very likely to spread. So, and continue to be very lucrative for those that invest. I mean, the one thing that I guess I would say in caution the other way would be is to say, what would you expect an oil company to say if the price is $40 and it used to be $100 about whether or not they'll invest? I mean, I would certainly expect them to say, oh, we can't make money at this price, but I would also expect them to, over time, reevaluate and try to find ways to reduce costs, and that's precisely what's happening in the oil services sector. Is a number of the drillers and the like are saying, hey, where's my discount? I need, and that's part of the thing that's driven the consolidation that's taking place. And the prices are falling for the drilling services and all the associated services that are being provided, and labor as well. And so the bonanza is going, but we'll see how much stays. Is I guess the question.
I think we had one question back here.
Yeah, I mean, I wonder if we don't have an emperor's new clothes sort of scenario here, 30 years from now, people will be sitting in this room wondering what were these guys thinking. Because all these projections show that, the demand projections are up. I mean, who knows exactly how much, and there's elasticity, there's risk, uncertainty. And all of the pricing projections seem to be increasing, largely to reflect, the cost of extraction, like, deep ocean. And then furthermore, a considerable amount of this comes from politically unstable regions. And so, all right, we got a lot of LNG here in the United States, and I assume I'm going to be driving an LNG car in about 10 years. But someday, this stuff economically runs out. And so my question is there anybody in our culture who is seriously working on alternatives to this stuff when it runs out?
I'd say everyone is. There's almost... Oh yeah, there's lots of activity. Go over on the other side of campus. There's a tremendous amount of interest and work in all sorts of different sources of energy and ways to power vehicles, ways to heat homes, you name it.
My favorite is fusion.
Excuse me?
Fusion.
Yeah, there you go. I mean, we haven't even talked about nuclear power. I mean, nuclear power is, I'd argue, is the success story of the last 30 years behind shale gas. I mean, if you look at what's happened in nuclear power in America, the simple way to describe it would be as what's called the capacity factor, which is the total amount of energy you get out of the generation unit divided by the total amount you could potentially get by multiplying the capacity by the number of hours in the year. In the 1970s, the fleet-wide capacity factor for nuclear power in the United States was probably on the order of 60%. Now it's 93%. So essentially, think of it out of the same units, you're getting that much more. The amount of safety that exists is much, much higher, sort of reactor scrams, all that sort of stuff is way down. So, I mean, that's a huge source of energy that's right there, ready to provide zero carbon energy if you're interested in climate sorts of issues. So I guess my argument is I think there's lots of energy out there. It's just a question of, but the other is unfortunate, and is certainly true, is there is no zero risk energy. and so they all have environmental consequences, just to acknowledge that.
One of the areas that's going to have a big impact on consumption of oil over time, I believe, is electrification of the transportation sector from renewable sources of power. Key to two aspects of that is the continuing development of storage technology. One, we need lighter, longer range batteries for cars. There's some really interesting work going on at MIT and here on that front. And then a large scale storage technology, a lot going on there, have a big impact on dealing with the intermittencies of renewable energy. So I think 5 to 10 years from now, I think we'll see things very differently than we do today.
Carbon taxes anywhere?
Of course.
One of the things that our Energy Task Force is aggressively advocating is a revenue-neutral carbon tax. We've done a lot of work in that area, continue to do a lot of work, and are finding a lot of people talking about it.
Another shameless plug to a SIEPR policy brief on my website is proposal for Stanford to implement as a way to do it.
So is that it? I think we need to wrap it up. I'm getting the hook from the back. So thank you, Frank and Doug. Thanks for good questions.